Hello trader, and welcome to my channel. Today we're going to be talking about analyzing the market for the week, and also I'll be taking you some tricks to using the Fibonacci in your trading. So I'll be walking you through a simple Fibonacci strategy that you can use or that you can apply to your trading right away. So today we'll not only be analyzing the market, but I'll also take you through some simple strategy and simple tricks to trading the Fibonacci retracement. You ready? Let's go. My name once again is Gloria Adeoye. I'm popularly known as the Pips grabbing chick. I'm a Forex trader and also a trainer. I'm the creator of the 17-part video course titled Trades to Profit, because as a trader, my goal is not just to trade, but to trade to profit. And I'm also on the lookout to help people who are also eager to trade to profit do so. That's the reason why this channel is designed to provide you the educational needs, the educational ideas based off trading the Forex market that you can apply to your trading, and you will find success trading the Forex market. In my previous videos, I've done a lot of strategies, looked at shared a lot of nuggets that most traders have applied to their trading, and some have come to me with results. They've sent me emails, they've sent me messages, proclaiming that their trading game has improved. So like I said, I'm a trade to profit trader, and I'm of the goal to help you trade to profit. So today I'm going to be analyzing the market for the week. I'm looking at some currency pairs, and I'll also be teaching you some simple strategy that you can apply to your trading using the Fibonacci retracement. For those of you who know me, you know that when I'm doing my analysis, I prefer to do a top-down analysis. So if I'm going to be analyzing the pair for the week, I always like to begin from the higher time frame. So my higher time frame could be on the monthly time frame. Mostly, I take the trade from the monthly time frame, and then I take it down to the weekly time frame, daily, and then I look for entries on the lower time frame. That's just a simple strategy I use to trade to profit. Like, there is no overflogging, there's no overthinking it. It's just a simple clear-cut strategy. Do a top-down analysis of the market and know what to do. In one of my lessons, when someone was talking about one of the mistakes he made as far as trading goes, I did mention that one of the mistakes a lot of traders make actually is that they feel that because they are coming to the market should be ready for them, but that's not the case. That's not true. The market is not ready for you just because you want it to be ready for you. The market is ready for you when the market is ready for you. So a professional trader will always trade the market when the market is ready for them. So that you are analyzing the market for the week doesn't mean that the opportunity will present itself. The opportunity will present itself when your analysis and your trade plan has lined up, has aligned, has given you that clear signal that yes, the market is ready. So you only trade the market when it is ready and not when you feel that it's open, let's go trade. So when you're doing your analysis for the week, you create your trade plan after charting the market. Of course, you create a trade plan. I've talked about it extensively in my previous video. Please go check them out if you're yet to. And if you're new to the channel, don't forget to subscribe and click on the notification bell so you get all the videos as they drop. So this is the euro dollar on the monthly time frame. So I'm going to be analyzing it. Let me clean this out, and then let's take a look at what the euro dollar would likely give us this week. Now, initially, we've seen the euro dollar play out this triple bottom, and it has gone halfway to it. And then what did it do? It did a kind of correction or a kind of retracement, so to speak. Now, having done that, you already know based off a market structure that a triple bottom and pattern signals a reversal. That right, the market has been on a continuous downtrend. You see a triple bottom, then you expect the market to continue towards the upside. Now you've seen that move. You've seen the market give you a clear-cut directional move, which we like to call an impulse, and then the market began a correction. So Euro USD, technically speaking, is done, or is just coming out of a corrective wave or a corrective move. So naturally, you would expect the market to continue, isn't it? Good. So this is the first move, the impulse move. This is the corrective move. So now we're seeing market continuing. Now take a look at this tiny structure right here. One of the tricks to trading this continuative pattern is to also see your W formation. I think I've done a video on spotting or on trading M's and W's. Yeah, I think I've done a video on that. If I've not, I'll check and I'll do one. but go check out the videos I did on trading M's and W's. So one of the clear reversals you tend to see in the market is the W formation, the M formation. So the W formation tends to signal a buy reversal move, and the M formation signals a sell reversal move. So right here we're seeing a W formation clear, right, isn't it? And now the market has created or gone all the way up to the top of the W, so to speak, right? So when this happens, we're expecting the market to drop. In one of my videos, rules for trading the BTMM strategy, I did mention that you look for the market wave. I don't know if I've talked about the market cycle, but I did talk about looking for those W formation and trading them based off the levels. So one of the strategies of trading the market makers method is to look for the market maker cycle or the levels. So if we're seeing a W formation, then we're expecting to see a V, isn't it? Like for the market to drop to give us like a corrective, so to speak. I like to use the word corrective so that you won't begin to feel that this is possibly, like we're going out of the chart. So a correction is imminent. Right here we've seen a clear push to the upside, right? A clear push to the upside, so we're expecting a correction. One of the reasons why we're expecting that correction is that Euro USD is at a zone of resistance, so to speak, that is based off that W formation we've seen right here, is at a resistance zone. Take note, this is still the monthly time frame, so we're analyzing it based off the monthly time frame. So this zone right here is a zone that EU has been meandering around. So seeing as Euro USD have pretty much plateaued or found some kind of resistance at a particular level, we're expecting it to do a dip, we're expecting it to do a retracement. Like you already know, one of the beauties about trading Forex is that it trends, right? It moves in waves. It doesn't move in a straight line. It moves in waves. So the waves provides traders opportunity to join in the original trend, hence the Fibonacci. So if you've seen this clear push to the upside, then what you're simply expecting is a correction, a retracement, a pullback, whatever it is you want to call it. All right, so what are the levels that you begin to watch? What are the areas that you begin to watch that this is the possible place where Euro USD will likely fall to? One of the tools that you can use to mark out these zones or mark out these levels is the Fibonacci retracement. Now I've seen a lot of videos on YouTube. I've heard a lot of traders talk down on the Fibonacci and come up with a lot of about it, but the truth is, as far as trading the Forex market goes, everything is under probability. There is no holy grail. Anybody that tells you they have the holy grail is lying. There's no holy grail as far as trading goes. A strategy is only as good as the trader using the strategy. So if you as a trader are using a strategy and you're misusing it, then of course strategy will not work. So one of the things why a lot of people find failure using the Fibonacci is because they misuse it. Somebody will just pick up the fib and just fib all over the place. Like they see a market move and they're fibbing, and they see a push, they're fibbing. You don't go fibbing like that. Like there is a mathematics, all right? There's a mathematics to this. The Fibonacci itself, if you Google it, it's got a lot of mathematical equation about it. All right, it's found in nature, it's found in virtually everything as far as life goes. So that's the reason why they've been able to inculcate it into the market. I'm not going to bore you with the history and the etymology of the Fibonacci. You go Google that up. I'm just going to teach you one of the ways that I use the Fibonacci that works, and one of the ways is for me to join the market in its original trend. So I am joining the market after the retracement, knowing that when the market moves, it tends to retrace. So at the point of retracement, I look to join the market, join the trend, join the movement. Now, one of the things some traders complain about is that, okay, they say that the Fibonacci tends to retrace between the 23.2 to the... So how do I know how to blah? Good. So what I just do, I pick the fib. Now I've seen what I want to fib. I've seen what I want to measure. I tend to see the Fibonacci as a ruler, right? Like a measuring tape, like a measure, something you just use to measure out stuff. If you're a surveyor or whatever, if you are, let me just use a very simple analogy, very simple. A tailor, you need a tape rule, right, to measure people, you know, take their height, the weight, the breadth, whatever, and then get the actual size. So that's how I see the fib. So I see it as a measuring tool. A measuring tool for me to measure entry, for me to measure a market move and see the areas, the level where the market will tend to retrace or drop. That's the reason why there's a theory to it, isn't it? That there's a theory stated by Dow. I know most of you already know about this theory, that a market will gain or lose 50 to 61.8% of the time. Like, it's just a theory. It's just there like that stated. So that means as a trader, you mostly focus on the 50% and then you focus on the 61.8%. That's like the rule, right? So you don't want to go look at the 23 like, although they say a strong trend, you know, if there is a range, if the range is between 23 and 78.6, then I might as well stay within the confines of the range. Like, let me tell you what I mean. Now here's the fib. Personally, I like to take it from the week. All right, I target the week and I place it on the week and drag it all the way down. That's just how I do it. That's just how I measure it out. That's just what I do. So what am I measuring? I'm measuring this move. So let me blow this out so that we can see clearly. So I place the fib first and then I start adjusting it. Okay, you already know the values of the fib. If you don't know, then you need to go, you know, read up the basic aspect of trading Fibonacci. Well, the values of the Fibonacci already right here: 178.6 and all that, 0 being the top, 100 being the bottom, depending on direction that you're pushing it. So in the buy direction, right, you take the fib from the bottom to the top, seeing that you're trying to measure a market pushing up, and you're trying to see it do a push down, like a retracement to the downside. So you take the fib from the down to the top because the market buys in the upward direction, right? So you take the fib from down to the top, making sure that 100 is sitting at the point where you're fibbing. So this is not what I'm fibbing. I'm not fibbing this move. This move is complete. What I'm fibbing is this clear, nice move right here, this continuous buy move. So I'm starting my fib from this bottom. So I'm going to adjust it and make sure that 100 is sitting at this bottom right there. Okay, hold on, right there, right? So let's make it good. So I'm very what's the word? Very particular about how I place the fib. So right there like that. So this is what I'm fibbing. Let me bring out one of the arrows and measure it out. So that's what I'm fibbing, just that zone right here. So I make sure that 100 is set at the wick. Why? Because that's a move. Price got to that point. Remember what you're trading here. You're trading rate of exchange. That's why it's called Forex, foreign exchange. So is the rate of the market exchange that you're interested in. You're interested in the rates, right? The market is at 1.07588 and the market is currently at 1.14714. Why would you want to buy at that point when you can get it at a better price? So it's the price I'm interested in. So if there is a wick right here, it means that at one point price was at 1.0765. Like, it's just clear like that. So why would I want to ignore the wick and then go take? No, it doesn't make sense. So I'm going to measure it out from that point where price was taking the wick and then place it at the last point that the market is currently sitting at. That is still the wick, because that's what the price is. All right, so now that I've done that, the next thing I want to do, the rule is that price will gain or lose 50 to 61.8% of the time. So that means on the Fibonacci right here, this zone here, this is the 50%. This is 61.8%. Here right here is 78.6, right? So the rule is that 50.61.8% of the time market will gain or lose. So that means traders begin to look at the 50% zone and the 61.8% zone. That's the traders begin to put their eyes and monitor and observe and all of that. So what does that mean? What does that tell you? It means that these guys know these rules. They know the rules, right? They create them, they set them, they teach you them, so they know. So they know that a lot of traders will focus on the 50% zone, which is, where is it? Right here. So they know that they will focus on this zone, right? All of these zones here, to focus on it, and then They put a lot of buy limit right here and all of that. So what do? They tend to take out all of the traders. When the trader enters here, it tends to place stop loss 30 pips below and all of that. They take you out, and then what do? Drive price in the normal direction. Remember, what you're trying to do is join the trend. Market has already shown you that it is about to begin a trend, like a continuous trend, an uptrend, right? The uptrend is just about beginning. So that push up, clear. You know that there's going to be a retracement. The rule is 50 to 61.8% of the time. So you keep your eye here, and then you place your buy limit here and all of that, and then they trigger it and hit your stop loss. So why look at 50% when you can look at 61.8 to 78.6? Because the truth of the matter is that there is a range. There's a range to trade the Fibonacci. The market tends to retrace sometimes at the 23.6. On a very strong trend, the market tends to retrace at the 23.6, or it might also retrace at the 38.2, or even the 50%. So if that is the range, the 23.6 to 78.6, if that's the range, doesn't it make more sense for you to target the closer, the area that is closer to the end of the rainbow, to the end of the range? So if 78.6 is a range and 61.6 is a range, I'd rather stay here. So this is my zone, the 61.8 zone to the 78.6, long story short. So my zone is the 61.8, 78.6. So I look for entry around these areas. Why? Because these are the areas, some people call it psychological level, ICT and blah, blah, blah. So these are the levels that I tend to focus on. Because if the market goes beyond these levels, then it is coming all the way. Because if I'm going to take my trade at the 78.6 and I'm placing my stop loss below 100, my risk to reward is better than for me to go place my entry here, and these guys come and hit my stop loss, and then hit my stop loss again and hit again, and then I get tired, and then one day I come and see the market buying. I'd rather place my entry at the 78.6 so that my risk comes below 100. Why? Because 100 could also mean that the market is looking to create a bottom, right? The market is looking to create a bottom. So if the price is coming all the way down, there's a video I saw that says if it goes beyond, if it first lower than 78.6, then it's no longer a retracement. Is blah 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 blah. Truth is, as long as you are looking to join the market in its original trend, when you take your entry or you place your entry around the 61.8, 70.6, by the time you place your stop below the 100, you stand a better chance to have your market not hit your stop loss. And if you hit your stop loss, then you know that it's not your fault. Price will continue to do what price will do, and it takes it like that. But 80% of the time, when I place my entries at the 61.8 to 78.6, the market tends to take me in and take me all the way to profit 80% of the time. So the remaining 20% of the time, the market is hitting my stop loss. So that being said, if I'm going to take this, say I'm busy, I go to work. If I'm going to take this, I place my buy limit at the 61.8 zone. So it could be here, or it could be here. So this zone right here creates my buy limit entry. So the Fib also has prices. So that means at the 61.8 zone, my entry price is 1.10214. That's where I'll place a buy limit. That's buy limit 1. Buy limit 2, 1.093. What's that? 037. Buy limit 2. So if I'm going to use a 0.5 or 1.0 lot size, for example, I split it 0.5, 0.5. Why? Because there are times when the market doesn't come to 78.6. It stops at 61.8 and continue a very nice move. While there are times when it goes big, it just wick, like it goes past 61.8 with a wick, just hit stop losses and then continue. So I have 2 entries in the market, and then price takes me in. So of course my stop loss is still 30 pips below my entry zone. Alright, or I just place it below the 100, whatever. So that being said, that's pretty much the simple trick to using the Fibonacci. I don't go fibbing all over the place. I only use the Fibonacci when I am looking to join a trend, like a new trend, a fresh trend, a brand new market trend. I don't fib anyhow. I use it when I'm looking to spot a new trend. So obviously you can see that this market is at a point where is just about to begin a new trend. This is an impulse, right? So we're expecting that correction or that retracement. That retracement, we're expecting it to this zone. So for Euro USD, I'm looking at this zone. So some traders will be looking to sell Euro USD for this week. And also, if you look left, you take a look at this point, you can see that there is a zone here, right? There's a zone here based off the W formation. Let me use this to draw it out. based off the W formation, there is a zone right here. Let me draw out this W. Let me draw it out so that some aesthetic learners will be able to see clearly. Alright, so you can see that W right here, right? So what we're expecting to see happen is that the market just picked up, right? That's W. So we're expecting a V, right? Now after the V, we're expecting another move push, right? And after that, we're expecting another what? Another V, isn't it? So that's just the market maker cycle, right? Expecting another V, and then continue like that. So ultimately, we're targeting this zone right here. We're targeting ultimately. We're targeting that zone, and the price pushes all the way up to that zone. Alright, so right now the market just got out of the second leg of the W, is about to create the first wave, the first level 1. Alright, so push down like that. Zone 61.8, 78.6, entry 1, entry 2, just simple like that. So some people might look to sell. That won't be bad at all, because this will be a very long, beautiful sell right to this point. So some people might look to sell depending on the strength of the dollar. So this move will likely play out this week. A sell move. But my goal, I'm not interested in the sell. I don't trade retracement. Alright, I only look to enter. I use them as entries. I don't try to catch them. I use them as entries. So what I'm expecting to see is price dipping and then pushing up. So how long this will happen, I don't know how long it will take, but I'll just keep my eye out and then wait for it to happen. So for those who like to trade the retracement, what would you like to see at this zone before you take your trade? Then you drop, you've already seen the big picture. You already see that Euro USD just finished an up thrust. It just finished an impulse. So now we're expecting a correction. So that correction, for those who like to catch the correction, you already mapped out your zone, that this is a zone of correction. Then you drop down to your lower time frame. Alright, and then begin to look for those tiny little details that will help you trade it. So before the market closed last week, you see a very clear sell candle right there. So traders will begin to look, to sell at that point, and you can also see a very clear information right there, more like a triple top information, isn't it? It's just clear for you to see. So you can see a triple top information, and boom, 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 the traders are just ready to sell. So this week, a lot of traders will likely be looking to sell Euro USD and all that. So what's the buyouts for Euro USD for the week? Traders are looking to sell, but I'm waiting for the retracement, because when the retracement plays out, we're looking at a very long term buy up for the market. So these are our entry zones. So these are entry zones, right? Push down to this point, zone, boom. So if you're gonna sell this, it's a cool sell market. It's a cool sell market. So based off tiny market analysis, you can see your channel right here, right? It's just clear. You can see your channel right here. You can see your channel right here, and then you're expecting to, the price to break out of it, and then you begin that sell. So the market is at a zone. So there's a bearish channel here already, right? So there's a bearish channel here already, and then market is giving you that, and then you can now look to sell. Even if you just want to do 30, 50, or 100 pips, you're good to go for EU for the week. So that's the buyouts for Euro USD, and you've also learned how to trade the Fibonacci. Don't forget to subscribe to the channel, and also send us an email to winningwithforex2.0@gmail.com if you have any questions. We're all about the Forex education. That's what we're all about. That's what we do. That's what we represent. And we're always here to help you trade the market profitably. So I see you again in the next video. Have a good evening and have a great trading week. Bye-bye. Bye-bye. Bye-bye.